Most people believe successful stock investing is about intelligence, about secret indicators, about timing the market perfectly. But here's the uncomfortable truth. If intelligence alone created wealth, Wall Street analysts would all be billionaires. They're not. Instead, history reveals something far stranger and far more unsettling. The biggest winners in the stock market didn't win because they knew more. They won because they followed a few simple rules, while everyone else ignored them. Rules so boring they don't make headlines. Rules so uncomfortable they feel wrong in the moment. Rules that seem obvious only after fortunes are made or destroyed. Tonight, we're uncovering 5 rules for successful stock investing, not as tips, but as a story. A story of rise and collapse, of people who followed these rules and quietly won, and those who broke them and paid the price. And by the end, you'll see why the stock market doesn't reward bravery, prediction, or genius. It rewards discipline. Setting the stage. The system behind the game. To understand these rules, we have to zoom out. The stock market isn't a casino. It's not a scoreboard of intelligence. It's a system, one built on human behavior, incentives, fear, and time. In the early 1900s, when stock markets were still young, legendary investors like Benjamin Graham noticed something strange. Prices didn't move based on facts alone. They moved based on emotions. Greed pushed prices far above value. Fear crushed them far below it. Later, Graham's student, Warren Buffett, would simplify this into one brutal observation. The stock market is a device for transferring money from the impatient to the patient. But patience alone wasn't enough. Across decades, from the Great Depression to the dot-com bubble, to the 2008 crash, to recent market manias, the same patterns repeated. Same mistakes, same justifications, same excuses, and the same 5 rules quietly separating winners from losers. Let's walk through them as a story. Rule number 1, understand what you own, the origin. The first rule begins at the very beginning, ignorance disguised as confidence. In the 1920s, everyday people flooded into stocks they didn't understand. Radio companies, automotive firms, new technologies. Sound familiar? People bought because prices were rising, not because they understood the business. Then came the crash of 1929. When prices fell, panic spread instantly. Why? Because investors didn't know what they owned, only what they paid for it. This pattern repeats endlessly. Dot-com stocks in 1999, crypto-adjacent equities in recent years, hyped next big thing companies with no profits, no clarity, and no resilience. Cause and effect is ruthless here. If you don't understand the business, you won't understand risk. If you don't understand risk, you'll panic at the worst possible time. Rule number 1, never invest in a stock you can't explain in simple terms. Rule number 2, price is what you pay, value is what you get, the rise. As markets recover, optimism returns, and this is where the second rule is broken. In every bull market, investors confuse a great company with a great investment. During the dot-com boom, companies with no earnings were valued higher than industrial giants. Why? Because stories were powerful. This time is different. It's about growth, not profits. Valuation doesn't matter anymore. It always does. When prices rise faster than underlying value, reality eventually intervenes. The cause is optimism without restraint. The effect is collapse. Rule number 2. A great business can be a terrible investment if you overpay. Ignoring this rule doesn't hurt immediately. It hurts later, when expectations collide with math. Rule number 3. The market will humiliate you, the breaking point. Every investor eventually meets this moment, the moment when confidence turns into regret. It happened in 2008. It happened during flash crashes, pandemics, and sudden rate hikes. People believed diversification meant owning 20 stocks, all in the same sector. They believed risk disappeared because prices kept rising. Then volatility arrived. The market doesn't care about your certainty. It punishes arrogance. The investors who survived weren't the bravest. They were the most prepared. They expected downturns. They built margin for error. They didn't assume smooth returns. Rule number 3, assume volatility, respect risk, always. Because the market's job isn't to reward confidence, it's to expose it. Rule number 4. Time is the real advantage, the fallout. After crashes come regret. People sell at the bottom, they swear off investing, they promise never to trust markets again, and this is where the greatest damage is done. Historical data shows something shocking. Missing just the 10 best days in the market over 20 years can cut returns by more than 50%. Those best days usually occur right after the worst ones. People who panic sell don't just lose money, they lose time. And time is the most powerful force in investing. Compounding doesn't reward intensity, it rewards consistency. Rule number 4. Time in the market beats timing the market. Always has, always will. Rule number 5. Your emotions are the real enemy. Failed fixes. After every crash, new solutions emerge. Better algorithms, faster trading, more complex strategies. But they don't fix the core problem. The core problem is emotional. Fear at bottoms, greed at tops, overconfidence after wins, paralysis after losses. Even professional investors fall victim to this. The market doesn't defeat you with complexity. It defeats you with simplicity you refuse to follow. Rule number 5. Build rules when you're calm and follow them when you're not. Modern parallels. Same pattern, new names. Look at recent market history. Speculative booms fueled by leverage. Retail investors chasing viral stocks. Narratives overpowering fundamentals. Different decade, same psychology. The tools change. Human behavior doesn't. That's why these 5 rules survive every era. 3 practical takeaways. 1. Invest in businesses, not tickers. If you can't explain how it makes money, you're gambling. 2. Demand a margin of safety. Overpaying is the silent killer of long-term returns. 3. Design your strategy for bad years, not good ones. Anyone can invest during booms. Survivors plan for storms. Final warning. Open-ended thought. The stock market doesn't promise fairness, it promises opportunity with consequences. The question isn't whether markets will crash again, they will. The real question is, when they do, will you react like the crowd or like an investor? Call to action. If this changed the way you think about investing, subscribe for more deep, story-driven breakdowns of money, markets, and mindset. And before you leave, ask yourself one thing. Are you investing with rules or with hope? Because the market only rewards one of those.